Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Joining me today is Dave Gill, portfolio manager responsible for looking after our manufacturing, transportation, or what we call the industrial sector, as well as technology. Welcome to the show, Dave.
Thank you, Mike.
Great to have you on. So let's talk about what we saw in 2023 across these sectors.
Okay, great. I think I should probably start the discussion by saying that the industrials and IT sectors tend to outperform on a relative basis early and mid-cycle. So when the economy is growing or rebounding or approaching its peak. And then they tend to underperform later in the cycle and during recessions. So when the economy is either moderating or contracting. Of course, every cycle is different. And other factors like secular tailwinds can come into play. But that's the general rule of thumb. So if we think back to 2023, it's hard really to talk about 2023, Mike, without actually thinking about what happened in 2022. And broadly speaking, and very quickly, 2022, as most investors will remember, was a very difficult year for capital markets. Essentially, we were dealing with things like potential runaway inflation. Central banks dealt with that runaway inflation by raising interest rates very rapidly. We also had rising geopolitical tensions in the breakout of the war between Russia and Ukraine, which caused a commodity spike and basically worsened the whole issue. With that, equity markets in North America traded down substantially. So the S&P was down about 20% and the S&P TSX was down about 9% on a price basis. At the sector level, so focusing in on industrials and IT specifically, the IT sector was sort of a middle of the pack performer, whereas information technology led the way to the downside. If I could just maybe spend a couple of minutes talking about why that is, specifically focusing in on the information technology sector. If you look back to the performance in 2022 of various asset classes, it was long-term bonds and technology which led the way to the downside. Both were down about 30%, which is obviously very substantial. The one thing that they have in common, many investors may not connect the dots, is that they're both higher in duration. So if you think about bonds, this is a term that more people are familiar with, bond duration. If you've got a lower coupon and a longer term to maturity, essentially you have a higher duration. So when interest rates go up, bonds move down. On the equities world, which is what we're concerned with today, duration is higher when ROEs are lower, so return of equities are lower. Valuations are higher, and dividend yield and dividend growth are lower.
It is interesting to think about tech as a duration play. You talk about the long-term bond, but it makes sense. It is a play out into the future, right? That typically the valuations are higher because you're expecting growth further out in time. So interesting.
Yeah, exactly.
So carry that forward.
Well, if you take those characteristics or attributes and sort of cross-check them against the equity market landscape, you can see, to your point, that IT has the highest duration across all equity sectors, which is why it traded down in sympathy with long-term bonds in 2022. Now, just as an example of this, if you look at the Canadian equity market, there's a name most investors are probably familiar with. It's Shopify, which is a global e-commerce platform provider to smaller and mid-sized businesses. In 2022, Shopify was down about 75%. Normally stocks like Shopify are valued on a sort of multiple of revenue basis as they're trying to emphasize growth. But let's just use earnings as a proxy because more investors are familiar with that metric. It was entering 2022 trading at about 200 times next year's earnings. It had an ROE of around 10%, and then it doesn't pay a dividend. So you can see it fits squarely in that in that bucket of stocks that have higher duration, which is why it traded down so significantly in 2022.
Okay. And just a reminder to folks, Shopify is not actually one of our core picks. Maybe you want to just quickly say why that is.
I mean, the bottom line is, Mike, and I think you've done a good job of explaining this in terms of the overall investment philosophy at TriCert, and it's quality. And but having said that, I guess the fine print is that it's quality at a reasonable price, not quality at any price.
Exactly. Okay. All right. Bring it to 2023.
Yeah, 2023. So again, I mean, 2023, the reason I talked about 2022 is because you can't really think about 2023 without understanding with what happened the prior year, because it was a complete reversal of that prior year. So whatever we saw in 2022, the complete reversal we saw in 2023. And that was really spurred by the surprising resilience in the overall economy, moderating inflation, and then more dovish commentary out of global central banks. In North America, the S&P 500 was up about 24%, and the S&P TSX was up about 8% on a price return basis. At the sector level, on both sides of the border, it was really a technology story. Given my comments earlier about duration and cyclicality, that is kind of what we would expect.
That's great, Dave. So now talk about our core picks on the tech side, maybe one in particular, perhaps.
Yeah, absolutely. I can probably highlight one of our core holdings, and that is in the software space, Microsoft.
Right.
It's a name that we like, and they actually reported their second quarter fiscal year 24 financial results recently, which showed strong revenue growth and earnings growth. If you think about two key drivers for the name, they experienced 28% year-over-year growth in Azure, which is basically their cloud platform and related services. And that included, according to management's guidance, about a 6% lift from AI. And then they're also experiencing generally strong demand for the company's entire ecosystem that has now been updated with AI functionality. The basic premise here on the name is that customers should be able to accrue significant operating expense efficiencies by using Microsoft's products with only a modest uptick in software spend. Overall, the financial results from Microsoft support the case that Microsoft really has an early leadership position in capturing and monetizing Gen AI opportunity.
And it's interesting, the whole AI side of things, and we've chatted about NVIDIA before. I mean, I think anybody who tracks this see the tremendous results they're putting up, which is fantastic. Not one of our core picks, and we've talked about it before. Back to what you mentioned about Shopify. It's like we are looking for quality holdings, but not at any price. And so that's the story on NVIDIA. So that's great, Dave. Let's pull it back now to industrials. What did we see in that sector for 2023?
In industrials, I talked about earlier about how industrials often trade, sort of in sympathy with the broader economic environment. Generally speaking, I would describe economic growth as tepid for the year and even for the forecast for 2023. If you look at key indicators like consumer spending or industrial production or even manufacturing PMI, just broad economic indicators, or we could even just wrap that up into just real GDP growth from a global perspective or even from a U.S. perspective. In 2020, when we saw the COVID, pandemic hit the markets, we saw global economic growth contract by about, call it 3%. The following year, it snapped back sharply. It was up 6%. So that kind of gives you the distribution or range of the worst case scenario and the best case scenario. Recently, we've seen economic growth around 3%. And for the coming year, just to frame it, we expect economic growth to be relatively subdued, kind of in the sub 2% range, for at least for the US and Canada. So that suggests that, it's tougher sledding for the industrial sector, which is really a play on the economy. Having said that, there are sort of pockets of resiliency. One name I would highlight is a name like Eaton Corporation, which is a name on our core picks list. It's basically a diversified power management company that has two main areas of focus. So it's industrial, so legacy business, which provides products to end markets like aerospace and auto. But then its real crown jewel is the electrical side of the business, which supplies products like backup power, power distribution, circuit breakers, and switchgear to various end markets. Just like Microsoft, they recently reported a very strong quarter with both strong revenue and earnings growth. The key driver was the company's Electrical Americas segment, which continues to benefit from a trend of the electrification of everything trend. Two additional kickers are strong growth in power-intensive data centers, which are needed to support cloud migration and Gen AI. And then, of course, a very favorable backdrop in North American mega projects. Management suggested that if you look at the market for mega projects, I think over $900 billion in project value has been announced since January 2021, which is about 3 times the normal run rate. And that represents a significant revenue opportunity for Eaton, which is why we continue to remain constructive on the name.
Okay, good stuff. Folks, as always, if you have any questions, don't hesitate to reach out to your financial advisor. And also don't hesitate to reach out to your portfolio manager here at TriCert Investment Counsel. And don't hesitate to reach out to myself. Take care.